Happy December 11. My name is Jessica Amir, market strategist here with Moomoo. It's great to have your company as always. So stocks on Wall Street closed higher. The S&P 500 hit its third highest level in history. It rose 0.7% after the US Central Bank, the Fed, cut interest rates for the third time this year as expected. Now, that gain was the biggest S&P 500 one-day move after a Fed meeting since March. Meanwhile, we did see the small cap index that we track via the Russell 2000 that powered to a brand new record all-time high. Why is that? Well, we've been speaking a lot about this. Small caps usually carry higher debt, so they're more sensitive to interest rates. C'est la vie. The Fed cut interest rates by 0.25%, but Trump said we should have got 0.5%. But here's what you need to know about what the Fed did and why this is perhaps a very bullish narrative for stocks. Here's what you need to know. Well, Fed policymakers see one more interest rate cut next year. But wait, there's more good news. The Fed also announced that they'll start buying bonds, about $40 billion worth per month, starting tomorrow. That's December 12 in the US. Simply, this supports the economy because the central bank will be injecting more money into the financial system. So naturally, this is going to push bond yields lower. And this is exactly what happened overnight. And this is a good narrative for stocks. The Fed's messaging was also supportive of the stock market as well. Why and how? Well, the Fed said that they basically see a stronger economy next year, lighter inflation, and neutral employment. Again, this is somewhat of a pretty bullish narrative for the stock market and commodities. And this is exactly why we saw 78% of the S&P 500 stocks close in the black or higher. Most sectors rose. Industrials and materials, known as mining, they rose the most, 1.8% each. The biggest gainer overnight was a standout, and it deserves an honourable mention. That is GE Vernova. This is an electric generation company used for the AI industry, and it rose 15% after the company doubled their dividend, and they announced that they're going to buy back more stock. And of course, when a company's buying more stock back and they're raising their earnings projections for the year, shareholders like that. And that's why its shares hit records. They also see $52 billion coming in earnings, and earnings before interest tax, that margin growing from 14 to 20%. So very good news. But going back to the takeaway of the day about interest rates, the takeaway is for investors or those sitting on the sidelines, remember that we now have a more favorable environment for stocks now. So why is this more favorable? Let's dig into the history books. The S&P 500 has historically gained, as I generally say, it's historically gained about 10% per annum on average throughout history. However, after a interest rate cut by the Fed 12 months after, we usually see the stock market gain on average about 11%. Small caps, though, they rule the roost. Small caps have historically outperformed large caps by 5% 1 year after a Fed rate cut. And again, this is just looking at the averages throughout history. Of course, history never repeats itself, but it does tend to rhyme. Gold, let's move to that. Gold has historically risen about 31 to 26% in the 24 months after a first Fed rate cut. But again, remember, I've spoken about this being the third rate cut. If you looked at the history books again, like I do a lot, the last 3 times we saw the Federal Reserve cut interest rates, gold rallied 99% on average from a trough or a low to a brand new record all-time high or a peak. So remember, the Fed began cutting rates back in September. So looking at where gold is now, you might be expecting more gains ahead. Again, of course, history never repeats itself, but it does rhyme. If you believe that this thesis could play out, do consider gold. Gold is only up 15% from the first rate cut of the cycle in September 2025. So you could be expecting more gains for gold and stocks over this coming year or so. That being said, let's change it up and move to stocks to add to your watch list. Let's kick off with a flavor of the day, and that is a gold miner, Ramelius Resources. Well done to you if you have bought into this stock this year. Yesterday, it was one of the best performing stocks on the ASX. It jumped about 6%. Why? A couple of reasons. Thanks for asking. Well, they announced a $250 million share buyback. Obviously, when a company is buying back their stock, that naturally inflates a company's shares. They are going to do this launching on Christmas Eve. That's my birthday, by the way. And given that gold also rose up overnight on the back of the Fed cutting interest rates, and they are seeing one more potentially rate cut next year, you do have to keep your eye on Ramelius, not just Ramelius, but other gold plays, other gold stocks and gold ETFs, given that the gold price is now at 4,235 US an ounce. And as the gold price continues to rise, well, that's what's expected following rate cuts. You would be expecting Ramelius to continue to do well. Ramelius's shares already doing well. They're up 71% this year. The average analyst actually sees more upside ahead, and the stock has got a buy rating. Let's move to what made major headways in the US overnight. Driverless car leader Waymo. Of course, they're owned by Alphabet and they're gaining ground. Waymo is now seeing 1 million fully driverless rides each month. That happened this year. And they plan to scale up to 1 million robo-taxi rides a week from next year. Why and how? Well, they're currently operating in San Francisco. They're doing trials in New York, and they're planning to launch into 20 more cities next year, including London and Tokyo. What's even more amazing is that, think about this, how many EVs are in Australia? Well, not many. About 12% of the EVs sold down under here in Australia are electric, but at the same time, we've got Alphabet's Waymo logging 14 million trips this year. That's triple last year's tally, and the company is expected to surpass 20 million rides, lifetime rides they call them, by the year end. Now, this announcement was not liked by those that own Uber and Tesla. That's why both of those shares, they were sold down by shareholders. Uber falling the most out of the bunch, down 4.5%. But back to Google and Waymo parent Alphabet. Alphabet also announced many other things. One of those that they announced last night was that they're planning to spend more on new data centers, planning to build a new data center outside of Dallas. Going to fork out 880 million US for that. They also announced more announcements to their AI leader, their AI used tool called Gemini 2.5, many announcements there. But this basically proves that Alphabet is not just a one-trick pony. For those of you who only thought Alphabet runs Google and YouTube, guess again, it's probably soon going to be the most powerful company in the world. That's probably why it was upgraded by a bevy of analysts overnight, such as Citizens, giving it a $340 price target, and RT Research gave it a $380 price target, but it closed at $320. Last but not least, Oracle. Let's move to that stock. It's in the doozies. Its stock is now down 10% after hours. That's because they reported results and obviously they missed expectations. No one likes opening up a bad present, do they? So what happened? Well, cloud revenue disappointed. All in all, broad revenue actually was under analyst expectations. No surprise, that's why their shares go down. And earnings disappointment always puts price pressure on the company's shares. So what happened? Revenue hit $16 billion, cloud revenue coming in at $8 billion, again, under expectations. But we do have to say that their earnings are rising. Oracle's adjusted earnings actually climbed 38%. But the problem is analysts expected quite lofty things and it's not really meeting the mark. That is what's happening. So Oracle's ability to capitalize on AI demand for cloud computing is being questioned, even though it did announce new deals with Meta and NVIDIA overnight. Let's have a look at Oracle's shares. They have fallen from $346 in September down to $223. But they're still up 32% this year. And the stock should be on your radar. Something to watch and consider. Thanks for your company.